month. They were expecting 1.1%. Again, it came back in much lower than expected at 0.5%, despite this increase in energy prices. When we think about the Fed Fund futures and where they are currently trading, they have pulled the rate cuts all the way from December to October to September of 2027. And so the perception is that this lack of inflation will result in the Federal Reserve cutting interest rates sooner than was previously expected last week. Now, as we have rallied away from our long setups here, remember that the lows inside of this 53.25, we have now rallied 600 points from a profit target of a traditional short setup. That was our low down here coming out of March 30th. We have screamed from that profit target away from traditional long setups to and through profit targets into extensions, which we traded yesterday coming out of our pre-market time frame, and then to that target and are going straight up in extensions of extensions. You'll notice that 63, 53, we have now rallied all the way to the 69.50s. We've rallied all the way to the 69.50s. We put on 100 points, or excuse me, 600 points from the end of March. 2 weeks, 600 points, 2 weeks, essentially 10 days. And the markets have to keep going straight up in extensions of extensions here, or we will have potentially fallen back down into and had a very similar type of situation to actually what we had coming out of the 9th and 10th of March. And you can see this, it's a little bit smaller version of what we're in right now, but it's the same pattern. We had a profit target that was hit. We had traditional long setups that defended. We went to and through profit targets to start extensions, and then extension long levels traded and then completed and then rolled over and broke our extensions. And the markets then made new lows. And that's the concern right now. The VIX is in a brand new contract as of tomorrow. The VIX is in a brand new contract as of tomorrow. And it has to keep going straight down in extensions of extensions. Otherwise, we're making a much larger retracement back up into our resistance. And so we're trailing these extensions as we move along here. And right now, the line in the sand, drawn from last week Friday's lows to lows, 2105s to lows, our bearish below line in the sand is the 2071. Rounding up to 75 and then adding a tick would be the 2080. And so everything below that 2080 represents where the VIX will continue to weaken and the indices will continue to strengthen, straight up in extensions of extensions. But if we should break those smaller extensions at any point this week, we have a much larger fall into our support level. And of course, when we're thinking about this from the perspective of that same anchor to new high, that would essentially be down at the 6801. And from our current high, that is 150 points below us. So if we don't keep going straight up in extensions of extensions, we have a 150 point pullback essentially into the next known support level. And that's just the range of the market. You can see the reaction to the target. This stream continues at eminiaddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.